So the company had some very successful promotions they ran last year, and they were lapping those promotions. And then also you saw less delivery sales from some of the other aggregators that they had been piloting tests with. Those sales at those on those sites started to slow as well, which affected the mix.
They knew that that was coming. They had predicted that there was going to be an impact. Was the expectation that it was going to be far less than what it actually was?
I think so. They definitely communicated to the street that they expected sales to be disrupted because of this transition. I think a lot of analysts, including myself, we would see the Shake Shack available on some of the different websites like DoorDash and Postmates still available because there was some integration there. But the promotional activity on those websites wasn't as strong this year as it was last year. And so consumers started to buy less Shake Shack on those websites.
Chris, this is Marcus. I have a question for you. So we know that these food delivery businesses eat into the margins pretty significantly, right? There's a pretty significant premium to get that product delivered. Is Shake Shack's decision in your mind better because it allows them to negotiate a better deal long term with Grubhub?
It's a good question. I think it's going to still be, it's still undecided. We don't know yet because even though the commissions are better with an exclusive relationship like this, we are finding that consumers still go to these other websites and they're not as loyal as maybe many people think. So we could still see some consumers hop to DoorDash and Postmates and other websites. It'll also depend on how many restaurant companies are participating on those other websites because consumers like the variety of these marketplaces. So if you're a DoorDash and you have a lot of chain restaurants participating on your marketplace, you're going to attract a lot of customers.
What's the bigger picture, Chris, in terms of consumer preference for quick serve? I mean, are burgers oversaturated at this point? It seems like the ones that have a little bit of spark of growth seem to have some sort of chicken offering that's capturing the public's attention. A Wendy's, a Popeyes with QSR. McDonald's is going to now offer a chicken offering in 2020 or so. And you're recommending that instead of Shake Shack, investors go into Wingstop.
Right. The chicken sandwich craze is definitely a popular trend right now, and a lot of chains are starting to participate in that. I don't think burgers are going to go, I don't think you're going to see a decline in burger sales per se, but consumers are looking for more convenience with fast food chains, or at least the perception that it's more convenient. So I think you're going to continue to see kiosk, digital ordering be very popular within fast food chains, anything that'll reduce that friction when the consumer interacts with the chain. You're right, we are very excited about Wingstop's outlook. And one of the things that we like about Wingstop is it has a similar rate of aggressive growth that Shake Shack has, but it has higher store level margin, has higher corporate level margin, and the franchisees are the one funding the unit expansion rather than the company. So the return on invested capital is much higher as well.
Chris, I just want to challenge you on two things. I'm a Shake Shack believer, not just as a consumer, but as a business model. And their user experience, their consumer experience is pretty darn good. The one that opened by my house, I can get in and get out pretty quickly. I think the unit economic discussion that you made and the corporate EBITDA margin that you mentioned, keep in mind that Shake Shack has had a pretty rapid expansion. Once those stores start to mature, I think you'll see that come back into fruition a little bit. I wonder if some of that is just some short-term pressure.
There's no question there's some short-term pressure with beef inflation and some of these delivery commissions right now. And there's no question that Shake Shack's a very compelling brand with consumers. One of the things that's a little bit different about Wingstop than Shake Shack is Wingstop's a highly franchised business model. So a lot of the capital outlay is being incurred by the franchisees rather than the company. And the fact is the Wingstop unit economics are actually better than Shake Shack's, which is pretty impressive because, as you mentioned, Shake Shack has a very compelling business model.